presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Welcome everyone to this weekly edition of the Compact Market Wrap YouTube edition. I'm your host today, Javaid J. Ansari, Executive Vice President here at Compact Asset Management. Now, of course, you can tell, filling in for your longtime host, Mo Ansari. He's taking a little bit of a break the next couple of weeks, kind of gearing up for that final run in the election and, of course, everything that's going to possibly come after that. So while he's taking a brief break, I'm here on the desk today to walk you through this weekly edition of the Compact Update. But once again, if you would like to, please just go to our YouTube channel. Once again, compact.com/YouTube. That's where you can see the latest edition of this update. Please subscribe to the YouTube channel and like. That helps us here at Compact to get out distribution to this, to all of our listeners out there. And I would say the bigger piece is interact with us. Email or call. Email us at invest@compact.com or give us a call the old-fashioned way, as Mo likes to say, at 800-388-9700. We love hearing from our listenership, learning a little bit more of maybe what you want us to talk about, both in the YouTube as well as on the podcast. So a lot of it is user-driven. We're always kind of taking in the weekly events, of course, what's happening in the markets economically and globally. But there's always things that our listenership might want to, hear about and hear Mo's opinion on and my opinion on. So we're here to please. So shoot us an email, invest@compact.com, or just give us a call at our longtime 800 number, 800-388-9700. So let's go ahead and jump into it. We saw the S&P 500 up 0.26% last week. So positive week, I would say, given how things started out in October, a little bit shaky. I think the market is still kind of a little worried with where we're headed in terms of the election. It's going to be tight. We know that. Exactly what's going to happen on election day and after that. And just in general, we're up so much for the year. We look at overall year to date up almost 22% for the year. So inevitably, we're probably going to get a little bit of correction at some point, you would think. We've seen a couple of dips here and there throughout the year, but nothing dramatic. Maybe now with the seasonality here in October, we might be setting up for that. You did see the Russell was down a good amount, just about 0.5% last week, so don't like to see that kind of broadening out that we saw towards the latter half of September kind of reversed last week, and then clearly even international stocks were down almost 4% for the week, and then you can see that NASDAQ also just flat. So a pretty kind of calm week in the markets. Overall kind of down, and then of course we'll get into the job data that we had on Friday, which was also very positive. But overall, I think the market is still digesting some of those returns that we've accumulated so far this year. Breaking down and looking at the sectors, we saw energy up big. I think a big part of that was that energy was lagging all year, but up almost 7%. And I think, as we've talked about in previous editions of Market Wrap, that energy and oil prices are somewhat of a proxy for the tension in the Middle East. So clearly things have ratcheted up there in the Middle East with the now interaction between Israel and Lebanon and Hezbollah and the IDF. And if that continues to kind of escalate, hopefully doesn't broaden out to, definitely including Iran into the equation, that can start to put some inflationary pressure back into the overall global economy. Now, the good news is, at least in the U.S. perspective, is that we are now a net exporter of energy. So crises that used to happen in the Middle East in the 70s and 80s, then saw oil prices spike to the upside. We're not as sensitive to those price changes as we used to be because of fracking here in the United States of America. But it still has an effect. Clearly, we still, oil is a huge consumption commodity across the global economy. And so if we start to see elevated oil prices over time, that can be inflationary and also cause a little bit of trepidation in terms of the Fed rate cuts that have currently been priced into the future for the market. We'll talk a little bit about rates and all of that with the technical analysis here on the YouTube. But overall, you can see some other sectors down. You saw some more of the, if you look at real estate and some of these more, I would say, somewhat interest rate sensitive type of sectors starting to take a little bit of a dip as we now basically have seen rates go up since the Fed has actually cut rates. And I'll talk a little bit about why that is. I think we were a little bit oversold going into that Fed rate cut. And so now we're starting to see the 10-year come back to the upside. In fact, hitting almost a recent new high here, near 4% today. But you can start to see that oil price going back up to $73. You compare that, though, to where we were back in October of last year, was $84. So oil prices are still down. So that's why I feel like when we're looking at the oil market, it's still saying, yeah, things aren't completely great, and we're headed to those lower rates that we saw to almost $40 a barrel, $50 a barrel, like we saw for the last couple of years, going prior to 2022. But at the same time, still not in that crisis territory that we saw during the invasion of Ukraine back in early 2022. Gold also, you can see overall commodity prices have been going up. So something to definitely watch, I think, is just on the margin as we continue to assess what the actual Fed is going to do here going forward. In fact, this week on Thursday, October 10th, we will be getting the CPI number. So we'll get some more inflationary data. I don't think it's as important as what it was when inflation was running at 5, 6, 7, 8, 9%. But still, I think it's important to kind of signal exactly to the market what the Fed's going to do. And so as we get this new inflationary data, we'll really kind of set the tone for what this actual Fed easing cycle is going to look like. And we're just clearly in the first inning of that. By the way, all of our Market Route listeners, hopefully you're enjoying that playoff baseball. I sure am. I have a young one in Little League Baseball, and so we've been watching those Padres. We're hoping that they do well in this playoff season. So once again, looking at bonds, you can see they were down almost 1% for the week, just a function of those rates going up. You can see that both the 2-year now up to 3.93%, and then the 10-year up to almost 4% towards the end of last week. And you can see, not a huge increase from where we were back in late September, but definitely an increase, and so that's affecting bonds. But I really like to focus on this, key piece here, and this is what I'm going to watch here going forward, is the performance or relative performance of U.S. aggregate bonds relative to high-yield bonds. So you can see high-yield bonds were only down 0.15% last week. So that's still very positive, and I think in line with the very strong employment number we got on Friday. So as long as, if interest rates are going higher, which I will take all day long, we want to see rates go higher, we see rates go lower from here, that's going to be some signs that maybe the market's beginning to price in some lower growth. We're not going to meet those rather rosy expectations, earnings expectations that we have in 2024. But as long as interest rates, if they're going higher, and we see that high yield index continue to outperform, in this case, outperforming to the downside, that's still, I think, very much a risk-on signal. And we have to kind of just work through a little bit of that volatility maybe associated with higher interest rates. But net, that's still a very positive thing as we start to see potentially the market just price in those growth expectations relative to those earnings expectations that are already priced into the market for 2025. So I'll be watching that. Saw a little bit of a breakdown today, actually. So I feel like we're just kind of in this seasonal October period. I think it's going to be pretty bumpy just because we're coming into this period up so much. We have an election, of course, coming in the next 30 days. There's always going to be some surprises around that and just overall anxiety. And that's what we're ultimately seeing within the VIX, which is a measure of short-term volatility. We're seeing the short-term VIX spiking here just over basically the last couple of weeks. In fact, if we look at it today, at 22.7 is where VIX is at today. So really, until that VIX comes back down below, I would say more around 17, 16, we're in this elevated period. I think we're going to have a lot of choppiness associated with the market until VIX resolves itself. But in the end, one of the big worries back in August was the jobs. We're going to start to see higher unemployment. The unemployment number ticks up. Well, fast forward here to the September job report. We had the numbers come in. We had 254,000 new jobs. Now, that's the initial report. Typically, that gets revised a couple of months later. But relative to the consensus number of 150,000, looking really good. We saw unemployment go down from 4.2% to 4.1%, and wage growth, which I also is a really key indicator, was also looking very positive. We saw at the ISM numbers last week. It looks like the manufacturing numbers have bottomed out, and the service number actually accelerated to the upside. And that kind of gives me a little kind of still concerned that I don't know if we're quite done with inflation yet. So with the Fed cutting interest rates, we'll see how this all plays out. And clearly we'll get another data piece going forward here on October 10th with the September CPI. But what the weekly chart is showing here is just, it's called the WARN Index. So this is Worker Adjusted and Retaining Notification Act. So this is basically something that the Cleveland Fed follows. And typically what you see is the WARN Index has about 2-month lead over initial claims or unemployment claims in the U.S. economy. You can see over here in the far lower corner, WARN has been coming down pretty precipitously over the last couple of months. And so that's why our expectation is, and we talked about this, is that the job market actually might tighten up here, even though it's been loosening over the next couple of months. Just because now with the Fed maybe cutting, now that we are getting into an easing cycle, corporations are saying, okay, maybe we can hire a couple more people. Once our debt comes due over the next couple of years, we're able to roll that debt at pretty favorable rates if rates are coming down, and then go forward from there. So I think overall, the economy is still looking very positive. Anyone who's kind of worrying about this job recession, I think it's a little overblown. I've talked about on the podcast that job numbers are typically lagging. By the time the jobs are going up, the market should already be down. By the time unemployment's going up, the stock market will already be down, I think, a good amount. So job market gives us a little bit of an intrigue into what the Fed's doing, but I think the Fed has a little bit of room to cut, just a little bit, and that's what we're going to see here initially. And then if the economic data and the inflation data kind of bottoms out, stays where it is today, that might be the extent of the rate cuts that we see from the Fed. Now, that's all positive. Once again, what the main thing we want to see is economic growth. We don't necessarily, I don't think we're going back to those free money days that we had from 2008 to basically 2020. Those days are behind us, a lot of it just due to all the money creation due to the pandemic and the fiscal deficit that we're running today. So if we do see those rates come down, I think that's going to be overall very positive. So once again, we talked about that jobs number last week coming in at 254, so that's all very positive. Once again, this week, the big number is going to be CPI coming out before the market open on Thursday, October 10th. Expected to be just in line with where it's been. And then we also have PPI coming out on Friday. I don't think we're getting a lot of, I think if we see a little bit of sell-off here in the early part of the week, and then that inflation number comes down, looks really nice, then that could probably put some solve on this initial start to a spooky October. But if that inflation number comes in a little hot, then we see interest rates continue to go a little higher, then the correction might get a little deeper here headed into the election. So diving into the technical analysis, as you saw last week, was just a pretty flat week. You can see kind of a big down day today, almost down 1% on the S&P, but still above the 20-day moving average, so still early days. And I'm thinking maybe we can get down to this 200-day moving average if the market really does want to correct. Maybe we get some higher inflationary numbers, so then the market has to reprice in all of these interest rate cuts that are expected here later this year, still about 50 basis points later this year, and then going almost 1% next year. So if we start to see a little bit more of kind of inflation being a little sticky, which is kind of my personal feeling, because when I look at the economy, you look at the Fed Atlanta Now GDP number, all coming in around 3%. I think that's all very positive for the economy. Once again, high yield bonds broke out in August. That's all very positive for the economy. I'm more worried about potentially seeing, we just have to walk back all these rate cut expectations that are priced into the market. Not the end of the world, probably leads to a nice little correction, but I think that's going to be a big buying opportunity if that does come about here over the next couple of weeks. But once again, keeping look at that high yield bond market relative to the overall bond market, particularly if the market's selling off due to higher rates. But the weekly chart's still looking very much intact. Mo and I talked about it on the podcast. Seems like we are in a wave 1. This is the correction we had in October of 23, wave 2. and we're just in a nice solid wave 3 here all the way to the upside. I'm thinking, maybe, we get into a wave 4 here, then you get back down to these levels, maybe sometime in 2025. But what I like about this wave count is then that still means we have a 5th wave to the upside sometime into the future. So we'll see how it all plays out, but always good to be, in a nice 3rd wave impulse move to the upside, and we'll just continue to watch that trend. But, good times right now from the technicals, at least Elliott wave wise. Looking at the NASDAQ, you can see a little bit choppier. I think Mo talked a little bit about it, but this seems to be a seminal time here back in July of this year. Basically, back in July 10th, that was kind of the peak AI kind of hype that we saw with NVIDIA and all these other really tech stocks making highs. And since then, it's been pretty choppy. We've seen a lot of back and forth. But most importantly, we've seen rotation out of more of these NASDAQ stocks into other S&P 500 companies, even into small cap and mid cap over these last 3 months. So that's a broadening out of the market. It's not necessarily a risk off signal for the market. And overall, I think that's very healthy for the market going forward. So I know all my NASDAQ followers out there, we're loving our triple Qs. We love all of that heavy tech exposure. It's been fantastic. But maybe things are starting to just broaden out a little bit because not so much that the tech companies aren't making money, making oodles of money, they're doing great, but it's just maybe those valuations have gotten to the point where the market says, hey, we just need to take a little bit of a breather here, see how this AI investment plays out before we resume back up to the upside. Looking at the weeklies, this is Mo's dot plot that he always likes to talk about on the podcast. So you can see here his dots were coming down until we hit those dots right here at 100, and now we have a new dot plot to the downside. But as Mo talked last week, typically when we get this new correction, the new dots to the downside are supportive of an up move, we tend to see a little bit of a correction going forward. And so that's what you saw here back in July of 22. We got finally up here to the upside, but that actually led to a pretty sizable correction, basically all the way down to the dots here in July of 22. So I think we're in that kind of, still can see some seasonally, or see some technical weakness out of the NASDAQ. But overall, I don't think it's you got to sell all your tech stocks and run for the hills. I think it's very much just a consolidation of what has been just one of the most epic growth creators in history, or wealth creators in history, which has been technology stocks over the last 5 to 6 years. So this is one of my most interesting charts that we follow here at the investment committee at Compact, but you can literally see the 10-year treasury made a bottom right around 3.6%, and then since that time, we've just gone boom, straight up here, almost to 4%. So I think we're kind of getting to, if you look at some of the levels, starting to get to a little bit of an overbought level on rates, and so I think it's just a natural extension of this big move. Basically, you can see May 1st was a key seminal point where the market's just been going straight down since that period of time in terms of rates. And so we're just kind of having a natural kind of corrective move back to the upside. I think it's a good time if you've been sitting in cash. Maybe now's a good time to maybe start dollar cost averaging in to some a little bit longer duration, buying some bonds, maybe going out 5 or 6 years. Now might be the time. At least it's been the best time. At least prices have been over the last 2 months. But who knows? I think maybe these rates could go a little bit higher. If these rates do go higher from here, that's clearly going to limit, I think, the upside on the stock market, and if anything, bring the stock market down a little bit in the short run. So a key chart to really watch. But once again, higher rates, I'll take it. I'd rather take higher rates than lower rates when you're looking at everything said and done. And then finally, both the oil chart has also exploded to the upside here. Now we're approaching the 200-day moving average, so we just hit that today. We'll see how the market digests all of this news coming out from the Middle East, but hopefully we just resume back to the downside, because that's going to really help not only, I think, temper a lot of where things are headed in the Middle East, but also bring down any sort of marginal inflationary pressure that we might be experiencing due to higher oil prices. And then you look at the small caps, still just kind of in their range. Haven't gone up a lot. They were down last week, so I think it's still early days for the small cap. We talked about it last week on the weekly chart. about how they're a little bit over. I mean, there's valuations aren't great, even though they haven't gone up a lot, because there's a lot of unprofitable companies, particularly in the Russell 2000 ETFs. So I'd still just kind of be pumping the brakes here before we see things kind of break out to the upside. And then gold has just cooled off. It's just been on a tremendous run here, just cooled off recently. So still above its 20-day moving average. Probably can maybe come back down. I'd maybe be looking at it somewhere in this range, around 2,500. If you want to start initiating a price on gold. So that's the YouTube update for this week, October 7th of 2024. Once again, if you're enjoying this, please do subscribe and like to our YouTube channel. We appreciate that. And once again, interact with us. Give us an email, invest@compact.com. Give us a call, 800-388-9700. Love to hear your comments, any questions, or if you're interested in learning more about Compact services, we're here to help. Once again, thank you very much for listening to this weekly edition of the Market Wrap Update, and I look forward to speaking with you next week. Take care.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.